From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for August 15th, 2025, and your Milwaukee Brewers are the hottest, best team in baseball. They just won 12 games in a row, and you know what that means, free burgers at George Webb's. The actual date of the burger giveaway is August 20th, between 2 and 6 p.m. The last time this happened, George Webb shelled out 90,000 free burgers and 100,000 vouchers. My wife just became a vegetarian, so I'm going to use her voucher. Not to overlook it, but this weekend's Irish Fest is also happening, and it's the 15th annual Community Arts and Funk Festival at the Peck Pavilion. What's sad is I have no idea what a Community Arts and Funk Festival is, but I know all about free burgers at George Webb. A couple of young California women kidnapped a man at gunpoint and made him drive because the car they were trying to steal had a manual transmission, and neither of them could drive a stick. Couldn't drive a stick. What's wrong with the kids of America today? And in Paris, France, police are considering whether to charge a man who was arrested for lighting a cigarette using the eternal flame at the tomb of the unknown soldier. That just leaves me speechless. And a Stoughton, Wisconsin pizza joint accidentally got 85 people high by using the THC-infused cooking oil. That's pretty efficient. You get high from the pizza, and the pizza takes care of your munchies. And finally, our own Joel Dresang is appearing this weekend in Arthur Miller's All My Sons, running through the 18th at the Next Act Theater. On the podcast today, we don't have Joel, but we do have Steve Giles and Kendall Bauer. And getting us started, here's Kyle Tetting.
Well, thank you, Max. You certainly have done a service to the community in reminding us of our free George Webb. So, I think we all were patiently watching the Brewers the first streak in hopes that maybe we'd get there, and all I think ecstatic that we got there the second time around. So thank you for the update there. A good week overall for markets. NASDAQ up 0.8%, closing at 21,623. The S&P up 0.9%, closing at the bell on Friday at 64.50. And despite a down day for the first two, big rally in United Healthcare on Friday helped push the Dow near new highs, closing at 44,946, up 1.7% on the week. Again, news from Berkshire that they've added a meaningful position in United Health, and United Health being such a big piece of the Dow, a little bit of a reminder that maybe that's one reason why we don't want to put too much emphasis on an index like the Dow, which doesn't really reflect the economy more broadly. For the year, NASDAQ up 12.5%, the S&P up 10.4%, and the Dow now up 6.6%. That's a quick look at the week. Steve, coming back from a couple of weeks away for you, and it feels like we're on that same trajectory higher. What are you seeing as you settle back into the work week, and what did you see while you were away?
Oh, thanks, Kyle. I actually was on vacation in a place where I had absolutely no idea what was going on with not only the Brewers, but I had no idea what was going on with the markets, and it was so refreshing. And I think a good reminder for our clients out there that like to check their account balances every day, sometimes twice a day, twice a week, that, go out and see the world. For all of you that are worried about what the Dow is doing or the S&P, there's a lot more important things in life. And coming back to it, I was wondering how I was going to prepare for the show. Kyle, I have no idea what's going on. I really don't.
Sometimes fresh perspective, right? And I think to your point, we spend countless hours prepping for the show and just kind of keeping abreast of what's going on in markets. And then maybe you get that reminder, right, that every once in a while it's nice to check out. It's nice to kind of just let the world happen, and then we'll pick it back up.
But on that same vein, I came back and the market hadn't burned itself down. Everything was the same as it was before I left. And in an odd sense, it was as though I hadn't even gone away. So in those terms, things just move along, whether we pay attention to it or not.
And perhaps we should make clear to your clients who might be listening that it's not as if there was no one tending to the store. Plenty of folks paying attention here on Steve's behalf, and we knew you were going to be gone, so that made it a little bit easier.
Yeah, that is correct. But it was nice to see the markets performing how we would expect them to, and whether we look at them or not, they're still going to be driven by ultimately interest rates and earnings.
No, I think that's fair. Kendall, I've had some questions recently from clients seeing some of the kind of mid-year capital market assumptions, and what we're talking about here is big investment firms, big research firms, kind of looking at where they see the long-term trends, where they see return expectations going forward. There was a big one from Vanguard going back to late July, but I've seen and heard others, all of them pointing to kind of higher valuations on the stock market as a rationale for why maybe return expectations for stocks might be a little lower going forward.
Yeah, maybe it's a little bit of under-promise, over-deliver. But to your point, at least U.S. stocks, I wouldn't exactly say they're cheap right now, but important, I think, sometimes not to put all our eggs in one basket of these types of forecasting, knowing that it's extremely difficult to predict what lies ahead. I do think, they can be helpful. Looking at something like international stocks coming into this year, right? I think that caught most of Wall Street by surprise. Certainly more favorably valued than U.S. stocks. They got a big bump in currency conversion with the weakening of the U.S. dollar. So, I try not to put too much into some of these model forecasts, but I do think they're helpful, certainly with some of the things we're looking at on the back end side of things.
Kendall, what I found interesting about that study from Vanguard was the expectation of U.S. equity performance in the 3 to 5% range moving forward. So we all know that historically stocks are going to do somewhere in the 9 to 10% range longer term, right, rolling 10-year periods. And we've come through a period of the general outperformance in the stock market. So the only way to get back to that average of 9 to 10 is going to be a period of lower performance to get back to average. And we call that regression to the mean. And I think it's a good reminder for investors in general not to rely on any one asset category. And it points to making sure you have broad diversification because we really don't know what next month or next year is going to bring.
I'd add maybe 2 key points. The first is that these forecasts often look at just big picture average where they think markets are going to head. And the challenge, of course, is that as investors, we're not looking for average. We're looking for the best opportunities for the risk we're willing to take. And so if what you're really doing is saying, well, maybe markets aren't quite as attractive going forward because of current valuations, the second part of that is, well, maybe there are things that look cheaper, either because from a current price perspective, they look cheap, or because from an earnings perspective, we think they can outcompete the average. And so I think it speaks to the role that active management plays. It speaks to the role that not just being an investor, but being a diligent investor, being a forward-thinking investor plays in, okay, how can I do a little better than what we think just the average stock's going to do? But the other is that these capital market assumptions are so focused on a time period that for most investors is largely irrelevant. Why am I concerned about where stocks end 10 years from now when that isn't the end of my journey as an investor? And more importantly, I didn't just start my journey as an investor. And so if what we are really talking about is what does an opportunity set look like over a period of time? Yeah, it matters what I think stocks are going to do versus other asset classes in the next 3 years, 5 years, 10 years. But they are just measuring points. And if you pick a different measuring stick, perhaps those return expectations shift a little. And maybe they shift a little in favor of one asset class or another. Yeah, we have to pick something, but is 10 years really just the way to do it?
And keep in mind, too, for those investors that want to try and, quote-unquote, time the market because they think the market is high, they have to be right twice, Kyle. They have to be right on the sell, but then they also have to be right on the buy. And that's really, really, really hard to do. And the average investor just, I don't think, is capable of making two right decisions back to back.
Meanwhile, Kendall, you have investors actively pursuing new opportunities. And one of the big things we've seen conversation around now is the introduction of private equity, private credit, typically less accessible markets, especially for smaller investors, but now bringing them into one of the most accessible investment vehicles investors have in their 401k. What kinds of things are you seeing? What kinds of concerns maybe do you have as we introduce some of these new vehicles to investors that maybe aren't used to seeing them?
Yeah, I think it's something to just proceed with caution. I think the part that might be more concerning is, some of the talks of weaving in some of the private equity vehicles into things like target date funds, which are often, when an employer automatically enrolls a participant, many times they end up in a target date fund just purely based on their age. So if you start to put in things like private equity, which there's a whole bunch of different hurdles and things to consider when using something like that, it just gets a little more complex. Not to mention if it becomes available as an option alongside other choices in the plan, you got to understand what you're buying. And I think it's just something that there's pros to it and cons to it, but something that shouldn't just be, in my opinion, thrown in and having people automatically invested in without knowing what exactly they're getting into.
Yeah, and those private markets, private equity and private credit specifically, one of the biggest risks for investors tends to be liquidity, that you can't immediately get access back to your capital. So you put money into this fund, you should count on it being there for a set period of time. And the good news for 401k investors, at least, is that it tends to be sticky money. It tends to be money that is going to stay around in the 401k for a while. I think the problem, of course, is that these investments tend to be black boxes, right? We don't really know what's in them. And even when we do know, or if we think we have an idea, they can change pretty quickly from one type of risk to another. And so I think there is a lot of concern for investors that, as a whole, 401k investors tend to be less sophisticated than the typical investor in those types of spaces. That's not a knock on the 401k investor. It's just they're not used to that type of investment. There are certainly some reasons to be extremely cautious. I would add that some of this feels a bit manipulative by the current private equity firms that are out there, a way to attract new money in an industry in which the bulk of their compensation comes from their ability to attract assets. And so if what you are doing, okay, maybe this isn't quite fair, but if what you're doing is just creating new pathways of growth to attract assets, well, is it really that you think every investor should have this, or is it that you have something to sell and you'd like more people to sell it to?
I think, too, just general numbers thrown out there in some of the articles about it, as potential opportunity, to your point, it's something around $4 trillion in potential untapped assets, that general 401k market. So a substantial chunk of change that these firms are looking at trying to get access to. And another thing that, often maybe doesn't get brought up enough is some of the higher fees that are, a part of things like private equity. It's not to say they don't have a role. On paper, it sounds like a good place maybe to have it in a 401k. Like you alluded to, typically money that's going to be sitting there maybe for someone's career at an employer, 20 or 30 years. But it is very much like a black box. There are things that can get fuzzy with how they report performance and how looking back at performance maybe looks a little more flatlined or less volatile than what might have been the case.
I spent my entire childhood with a father that worked at Snap-on Tools, and if there's one thing I learned, it's that everything you need to do probably has a tool that was designed specifically for it. And every tool has a specific use. And so I think things like private equity, private credit, certainly for the right application, they have a role, but you don't walk in with a screwdriver and use it as a chisel, as it says right on the side of the screwdriver. And so I think if what we are doing is saying, hey, this is something everyone should have, we're probably making the wrong statement. If what we're really trying to do, though, is say, here's another tool in your toolbox, well, then I'm all for kind of continuing to build out that tool set. The other big one that we have seen that I think impacts just about everybody is the state of kind of the current mortgage market and interest rates on the 10-year especially coming down a little bit since the start of the year, now seemingly stabilizing a little bit below that kind of 4.5, around the 4.25 mark on the 10-year U.S. Treasury. Kendall, that's kind of helped mortgage rates especially settle in a little bit lower here.
It has. It still doesn't fix the overall issue with the housing market, which has been and will continue to be, at least for the time being, a supply shortage. We're not seeing enough homes built. Some of that lingering pains maybe from the GFC and the after effects of some of those companies. But it's an interesting thought, experiment to look at the housing market and try to come up with some different paths where housing might become more accessible to, one of the biggest generations coming in as a first-time home buyer. And you run into, okay, mortgage rates coming down, but you still have a supply shortage. Prices certainly haven't indicated that they're trending lower, and everything we've seen, they've done nothing but move higher the past.
And an article in the Wall Street Journal late this week pointing out that the kind of lack of turnover in the housing market, people's unwillingness to move from one place to the next, may also be limiting job prospects. If you don't feel like you can move to take a new job, well, you may not be willing to take that job and make that move. And of course, one of the big ways that you can increase your ability to make more money is to take a job in a new area if they're willing to pay you more to do that, because they need more of what you can offer in a new part of the country, a new part of the world, whatever that looks like. And so I think a long way of saying the affordability of housing, part of that being mortgage rates, is a big part of the conversation just on the economy more broadly. And Steve, we got a lot of economic data this week, not the least of which data Friday on consumer sentiment. Certainly consumers feeling as if inflation may be on the rise, not quite as happy as maybe they were the last couple of months, still better than where we were looking back to April, May. But consumers such a big part of our economy overall, I think it's important to kind of look at how they feel.
Yeah, consumers had about a 5% pullback in how they're feeling about the economy. And again, this is a forward-looking number where University of Michigan asks two questions: how do you feel now, and how do you think you're going to feel in 6 months? And it's that second answer that we're always more concerned with, right? How do you think you're going to feel? And so there's continued deterioration in rising worries about inflation. And while it hasn't in all sectors hit people's pocketbooks yet, they're continually concerned that it's only going to get worse for them.
And what I find so interesting is that along with consumer sentiment, we got retail sales data. Retail sales, I wouldn't call it strong, but still growing, still showing signs that consumers, as we were talking about going back 4 or 5 months now, despite not feeling great, despite having expectations that maybe things get a little worse, they've still been willing to spend money.
Yeah, this is rather anecdotal, but it could be along the lines of, well, maybe we should buy that now before we can't afford it later.
And certainly we've seen producer prices, for example, which tend to lead kind of our expectations for inflation. Well, producer prices were up pretty meaningfully this week, signs that maybe there is some more inflation making its way through the system. And to your point, if I'm a consumer and I'm not feeling great about where things are headed, and I have some cash still now from saving it up over the last few years, well, yeah, maybe I am going to put it to work now. And so I think the real concern will be, how does that retail sales data shift going forward? And how do consumers really adjust to whatever the tariff conversation settles at, whatever else might be out there? Kendall, we had some other inflation data this week, and I know we keep kind of a close eye on inflation. I mentioned the producer prices being a little higher than we expected, but overall, the consumer price index, which really what we ultimately see when we go to the store, not as concerning, even if it is still elevated relative to what the Fed's hoping.
Yeah, not a huge jump from June to July, about 20 basis points or 0.2%. And on a 12-month look back, still at about 2.7%. Again, it's always interesting to me to see the uproar when the CPI numbers or PPI numbers come out and they're above or below target by these, we would think are smaller numbers, and how the market reacts. I think certainly the Jackson Hole meeting and all that from the Fed coming up in the next couple of weeks will be interesting to see what we get comment-wise from Chairman Powell.
Well, the market seems to want him to lower rates, and that now is kind of the over-under on
Steve,
what everybody's expecting.
Certainly expecting.
90%, 92%?
Yeah,
But
after producer prices, we moved to an 85% expectation of a rate cut, but that's virtually guaranteed if you consider what kind of the Chicago Mercantile Exchange typically thinks of.
Yeah, the messaging here, though, I think is important for investors, because the Fed is going to be looking at the decision to keep rates the same, raise rates, or lower rates based upon the economic data, not the pressure they're getting from the White House. And I think that it might get spun a little bit differently no matter which way Jerome Powell decides to go.
And of course, we've had some questions about the data itself in the last few weeks. And so as we kind of settle into a new BLS secretary, a new kind of regime in terms of how the data gets reported, you might even see some shifts in the underlying data itself that could be maybe a little more supportive of what the administration is pushing the Fed to do. And so
we should all just go on vacation for a few weeks.
I think a few weeks of vacation is probably the right answer at this point.
It's somewhere where you won't get news.
Plenty of other things to keep an eye on, plenty of other things to pay attention to, but another decent week overall. We've got a lot of traders, I think, still taking their beach vacations for the next few weeks as we wind down summer. But again, I think difficult to be too upset about where markets are right now.
And maybe just to comment too, I think we're almost all the way through second quarter earnings, which were good. So again, it's to your point, Steve, sometimes we get stuck in these cycles of doom and gloom when we're too sucked into our devices or whatever TV show we're on, and we forget sometimes, hey, first quarter earnings were good. That probably was a driver of this fantastic market rally we've been in the midst of since early May. And now second quarter earnings coming in, and maybe, again, sometimes we forget fundamentals truly drive things in the long term.
A fair point for sure, Kendall. And even if you do decide to tune off for the next week or two and keep the TV off and maybe don't pick up the paper, please make sure you download the podcast. We very much appreciate you listening. We enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.